last week, a slew of developments have raised the Reserve Bank's autonomy to the centre stage. First, on February 20th, Government and Reserve Bank signed a monetary policy agreement which sets Reserve Bank the task of keeping inflation below 6% until Jan 2016 and bring it down to 4% by Jan 2018. Thereafter, on February 28th in the budget, the government fails to keep the fiscal deficit to the pre-agreed limit of 3.6% for FY16. Yet on March 4th, the Reserve Bank gives an out-of-turn rate cut, justifying it partly on grounds of declining inflation and partly because although the fiscal deficit is higher than target, the quality of the number is better. The budget also transferred the power of making policies on equity-related capital controls from the Reserve Bank to the government. The Government Securities Markets regulation has also mostly moved to SEBI from Reserve Bank. Finally, monetary policy making will soon be done by a committee, and in the days to come, we will know how that committee is to be constituted. Are all these developments good for the monetary policy making process in the country? And secondly, has the RBI emerged more autonomous or less in the process? That's the question we are asking our very eminent panel today. Joining me are two former governors of the Reserve Bank, Dr. Jalan and Dr. Rangarajan, the business standards editor, AK Bhattacharya, and a voice from the market, Sajjid Chinoy, who was also a member of the Urjit Patel Committee, which was the original author of the Monetary Policy Framework and Agreement. Well, gentlemen, thank you very much for joining us. First of all, let me look at just the rate cuts and go from the minor to the micro to the macro. We hardly ever hear of the Fed giving an out-of-turn rate cut. Rate cuts are always given on policy days. We hardly hear of the ECB doing that. Does it tarnish the RBI's image if it gives regular out-of-turn rate cuts? That question first, Dr. Rangarajan.
Well, earlier, as you know, that the Reserve Bank of India used to have only two meetings in a year, and monetary policy changes were announced all through the year. Therefore, this bi-monthly monetary policy statement is a new phenomenon. It has not been here. It has not been there all along in the Reserve Bank also. Therefore, in some sense, binding oneself to a certain point in time is not a good thing. I think the monetary authority should be able to act whenever it feels there is a need for it. But however, having created such a system, sometimes this out-of-turn policy decisions do come as a surprise. I certainly thought that the latest move came as a surprise to me. Not necessarily the measure, but the timing of it.
Okay, AKB, is there an issue in this that, you get into a framework where you say that my part of the bargain is I'll deliver 6%, and all along the Reserve Bank has correctly maintained that a high fiscal deficit has caused inflation, and the government doesn't adhere to its set target, a target which was even reinforced by the Finance Commission, a constitutional body. And then 2 days after that, the RBI gives a rate cut. Doesn't that give the impression that there was pressure on them?
Well, I don't know whether there was any pressure or not, but there were enough signals from North Block to the RBI. Even if you look at the many comments that came after the budget and just before the rate cut actually was announced. So there were enough signals to the RBI that it is time to cut rates. So to that extent, you are absolutely right. There may not have been any pressure, but there were enough signals. And when those signals come from as important and significant a player as the Ministry of Finance, I would imagine that signal would be taken a little more seriously than your or my signal. On the point that you raised about the fiscal policy thing, and I think the Reserve Bank of India has tried to justify why the rate cut was necessary, because the quality of fiscal deficit, if you take the state's fiscal deficit and the centre's fiscal deficit together, there will be some sort of reduction, and the international, the rating agencies as well as the investing community always look at the total center and the state's combined fiscal deficit, where you will see some reduction.
Yeah, no, and there's also a point that the estimates this time are more real. Last year, the budget assumed a 13.5% nominal GDP growth. This time it is 11.2%. Yeah. Last time, the revenue growth was assumed at 19%. This time it's 15%, the tax revenue growth. So, okay, 15%. That point is taken.
It's much more moderated.
Yeah, that point is taken. But Sajjid, you know, just from a global investor's perspective, are out-of-turn rate cuts, I mean, a real and persistent danger, yes, merits always action out of turn. To stimulate the economy, an out-of-turn policy, how does it gel with other central bankers' standards? And more importantly, when the fiscal deficit target, the headline target, has not met preset expectations?
Latha, I think we need to look at the economic situation more holistically here. I think the context here is the RBI needs to be driven by the economic calendar, not by the lunar calendar. And the economic conditions suggest this. By the RBI's own inflation forecast, as recently as 4 months ago, headline inflation was going to be 8%. We are 300 basis points below your own forecast, and that's what's driving the urgency. So let me pose the question this way. What if the Fed found out that inflation was a couple of 100 basis points below its own forecast? You would see more urgency from the Fed. So I think you have to understand the January move and the March move in the context that inflation has fallen so much that even if there is some slippage on the fisc, it doesn't offset the other disinflationary forces. So I think, you know, let's give them the benefit of the doubt. I agree we should not make this a habit, but I think economic conditions today are quite unique. That, you know, some out of cycle cuts are not
Point taken. AKB and I are smelling a rat probably where there is none. Let me come to the more important question, the framework itself. Dr. Jalan, the monetary policy framework, it says that RBI's primary responsibility is to keep inflation below 6%. Is this inhibiting or is this autonomy enhancing? For instance, if the Reserve Bank were to notice asset bubbles in the housing market or, you know, even in the stock market, like was the case in 2007, when inflation was, you know, fairly under control, can it act? Does the framework actually inhibit it?
No, but my view on inflation targeting is different from what the accepted view is. You know, I don't think an inflation targeting is a good idea. I know a number of countries have adopted it, we have adopted it, others have adopted it, but inflation targeting per se, in our kind of an economy, where food prices are very important, CPI inflation is the target, and also the trade-off between growth and inflation is extremely important, you know, at different points of time. So this is a very personal point that I don't believe in inflation targeting per se. And but certainly the central banks across the world have adopted inflation targeting, but we had avoided it for quite some time, and I'm sure Dr. Rangarajan would have more to say on it. But I mean, these views are different, so I don't want to express a view on whether the inflation targeting should be this or that. But I just believe that the most important thing is low inflation, good growth, and as long as the two are consistent, we don't have to worry about whether it is 4.2 or 4.3 or 3.9. I mean, I don't believe in this first decimal point.
All right. Point taken, Dr. Jalan. But Dr. Rangarajan, you had earlier on my show said that it is an autonomy-enhancing framework. But what if financial stability is under threat, though the inflation numbers immediately don't give that impression? Will this prevent the Reserve Bank from working?
My interpretation of inflation targeting is slightly different. What inflation targeting demands from the central bank is that when inflation is outside the comfort zone, particularly on the upper side, then the central bank, the Reserve Bank of India in the present case, should act and should decisively act. But when inflation is within the comfort zone, other objectives also come into play. My point is that the Fed misinterpreted this, and Fed when it found the inflation is low, but when there were other factors in the economic system which demanded certain treatment, they didn't do it. I think my interpretation is that within the comfort zone, that if there are other factors which pointed towards taking a hard stand, it can be taken. But the most important thing is that when inflation is running above the comfort zone, the central bank, in this case the Reserve Bank of India, must act decisively. I think that is the correct interpretation of inflation targeting.
But Sajjid, if it is accepted that within that 6% it is the Reserve Bank's area of operation, does not this agreement bind the Finance Ministry and the government to not make statements which almost, place on the Reserve Bank a responsibility to cut rates? For instance, the one that AKB mentioned, a rate cut is imminent. We have created space for a rate cut. These sentences don't gel well. Clearly, the government is not keeping its side of the bargain, you think?
I think I worry less about the statements. I worry more about the actions. I think the idea is if you have a joint commitment by the government and the RBI to a public numerical target, whether it's 6 this year or 4 3 years from now, what it does is it disincentivize fiscal actions that are contrary. So what you will see because of this is that the fiscal consolidation path will not be questioned. Things like minimum support prices hopefully will not be revisited again, because the government knows there's an incentive compatibility issue here, that if the fisc misbehaves, then the central bank, because of its public commitment, is forced to more than offset that by monetary tightening. And I think that has been the beauty of inflation targeting around the world, that it has generated discipline from other economic actors that did not exist because of this joint public commitment. As long as that happens, I worry less about the statements. I think it's the actions that are going to determine the success.
I take your point. I mean, we are still in a stage of the framework itself being barely 15 days old, and we will start setting expectations and precedents hereafter. Yes, Dr. Rangarajan.
Can I come in?
Yes.
Yeah, you see, on the implication of this agreement regarding the responsibility of the government and the responsibility of the Reserve Bank, I think that with this agreement, the kind of concerns that you had will diminish. I think the agreement clearly states that if inflation exceeds a certain level, the Reserve Bank of India can take action. And therefore, the kind of nagging that we had seen in the last 2 years coming from the government would stop now, because I think they are a party to this. And they have agreed that it is the responsibility of the Reserve Bank of India to maintain price stability, and has defined what that price stability is. Therefore, I expect going ahead that the kind of signals and other things will stop, particularly when inflation is running at a higher level. Now, I think the situation is slightly different when the inflation is in the comfort zone. But what was happening earlier was, when inflation was really running at a very high level, there were indications for cutting the rate of interest. Now that they cannot make, because they are a party to this. Therefore, I think both the Reserve Bank and the central government need to play their part very well. I mean, the central bank also can make comments on fiscal deficit and so on, but not on other issues which are directly the concern of the government. And the central government also must refrain as far as possible on making any comment on interest rate.
Fair point, sir. Just one final question to wind up this. Basically, Governor Jalan, taking away from all this, are extremely strong political majorities inimical to institutions?
No, not at all.
Okay.
I mean, that's a good thing.
Okay.
I mean, there is no, I think the basic point is that we are part of the same political economic system. Okay. Reserve Bank of India, Government of India, the media, and everybody else. And we have different responsibilities. But it doesn't mean that these responsibilities cannot conflict with each other. And then you have to make a decision which is in consultation with others involved. And this is the role of the Reserve Bank of India and the government to ensure ensure that we have price stability combined with a growth. Now, the views may differ. I mean, if you ask 2-3 different people, they may have a different view.
Okay.
But we all have to agree that these are two very vital institutions, the fiscal part and the monetary part, as well as, of course, the demand part and so on and so forth, and the global situation. Okay. And all of these have to be combined in some way to give us what we want.
Okay.
So there is no easy sort of formula, as it were,
all right.
so far as I am concerned. Yeah.
Well, we need a break. On that note, we are back in a minute.